Hello, everyone. On behalf of the Environmental Finance Center Network, welcome to our webinar, Long-Term System Planning, Thinking Outside the Pipes. My name is Kristen from the Syracuse University Environmental Finance Center. Before we begin, we're going to go over a few logistics and then we can get started. During the webinar today, everyone will be kept on mute to ensure audio quality. If you have a question, please type it into the GoToWebinar question dialog box at any time throughout the session. We will be saving your questions for a facilitated Q&A session at the end of the presentation. After the webinar, you will receive a follow-up email that includes a link to the recording and other information that you may need. You can also download the slides from today in the Handouts tab in your GoToWebinar control panel. This webinar has not been submitted for pre-approval of continuing education credits, but eligible attendees will receive a certificate of attendance for their personal record. To receive a certificate for this session, you must attend for the entire session and register and attend individually using your real name and unique email address. Certificates will be sent via email within 30 days of the webinar date. If you have questions or need assistance, please contact smallsystems@syr.edu. Now for a little bit about us. The Environmental Finance Center Network provides training and technical assistance to small water and wastewater systems in all U.S. states and territories through our building technical, managerial, and finance capacity programs. If you or your community or utility needs assistance with drinking water or wastewater system management, please feel free to contact us through our request form, which I will be sharing shortly in the chat. And on that note, we can get started. I would like to introduce our presenter for today, Dr. Kristen Downs. Kristen is a project director from the Environmental Finance Center at the University of North Carolina, Chapel Hill. Welcome, Dr. Downs, and I will pass it right over to you.
Thank you, Kristen. As you can see, we have two Kristens here today for your pleasure. All right, I believe you should all be able to see my screen. Good afternoon or good morning, depending where you are today. As Kristen mentioned, I will be talking to you about long-term system planning, thinking outside the pipes. So today we are going to cover a number of subjects. We'll first review the basics of utility system financing, go over why it's important to have a realistic revenue requirement, and then review a number of measures of financial performance benchmarks, and round out the session today by introducing rate setting philosophies and considerations for designing appropriate rate structures. So we're going to start with a few questions about for you and the polls. I'll let Kristen take it from here.
Yes, and we want to know what type of role you are currently in. So go ahead and get those answers in. I'll give you guys a little bit more time. All right, and I'll be closing that poll in 3, 2, 1. And Kristen, it looks like the majority are consultants or technical assistance providers, about 46%. We also have 34% are managers, owners, or operators of water or wastewater systems. And we also have some from the other groups as well, but the majority is technical assistance, consulting, or water or wastewater system manager, owners, or operators.
Great. Well, it's wonderful to have you all here. Thank you. So in our second poll, we wanted to know about the last time your utility raised their rates, for example, in the last X years. If you're not sure, then go ahead and mark unknown.
And get those answers in. I'll be closing the poll in 3, 2, 1. All right, Kristen. So the majority of people say that it is unknown when the last time their utility raised their rates, about 44%. And then we also have 34%. A close second said a year or less.
Great. Well, that's helpful to know that many of you have raised your rates within the last 5 years. That's great progress. I am suspecting that some of you, it's unknown because you may not work directly with the utility who's setting those rates, or because you're not sure. So if you are in a place in your role where you have an influence on rate setting, in the back of your mind, think about, as we go through thinking about your financial health and long-term financial sustainability, whether that's something you may need to consider for your system. Okay, so water systems serve multiple purposes, as you are aware. First, they provide environmental and health protection through water resources and supplying the highest quality drinking water. These are subjects to rules and regulations for the protection of public health. Water systems are also in the business of public service by providing basic services that everyone in the community can afford. So there's kind of a low margin for error, since this is an important service that we provide to the public. I'm sorry, I'm having a little bit of issue with automatic slide changes. So I apologize if I have to go back. I recorded this earlier and I didn't realize that it remembers how much time I spent on a slide. So lastly, water systems also are public enterprises often. So because of this, it's important to put sustainable business practices into action in order to cover your costs, which can be substantial. So overall, to serve all of these purposes, water and wastewater systems need to be sustainably financed, and how you pay for that matters, which is what we're going to talk about today. First, we'll review the basics of utility finance. Many water and wastewater enterprise or wastewater systems are managed as enterprise funds. This often allows utilities to be self-sufficient and keep their funds separated from other funds. But it's important that revenues collected equal the cost expended, as well as to avoid or minimize transfers between departments for the health of the enterprise fund. We're going to talk about the revenue requirement, and this is the science part of rate making. We try to determine how much revenue we need to meet for the financial health of our system. This sets the bar for how much you need to operate for financial sustainability. There are 3 types of costs, which are the components of your revenue requirement. First, there are operating and maintenance costs. Now these, it's important to remember that there is no external funding for operations and maintenance, and so it's important to be able to pay for these within the revenues of the system. So some suggestions that you can do when considering your O&M. So look at trends from previous years and challenge your operators to look for cost savings. Pay particular attention to the largest buckets of expenses that might move the needle for cost control. It's also important to look into the future and anticipate changing costs, whether that's due to regulations or increasing costs or changes in your population. And don't forget about indirect costs of running the system. These include shared management costs or shared facility costs. Our second type of costs are from capital for the rehabilitation and replacement of existing infrastructure, as well as for new infrastructure. Here, asset management and capital improvement plans are key. So it's important to be flexible in your spending, but not to manage to failure. So you want to have to be able to meet your anticipated costs and to be able to save for the future in order to replace your assets. And finally, there are also costs from debt service. And this is where you can prep for debt service by thinking about your cost recovery from your debt and how you'll pay that back, pay back the principal and the interest on what you owe on loans and bonds. Next, we have two types of revenue. First, there is system income. This comes from rates, tap fees, system development charges, grants, penalties, and other sources. For a pure enterprise fund, this does not include taxes unless explicitly permitted. Oops. Then there is also revenue from debt. Debt's often seen as an expense, but money from bonds and loans can provide capital for capital projects in order to pay for your infrastructure. There are a number of types of reserve funds. These include capital reserve funds for infrastructure rehabilitation and replacement, repair funds for known and ongoing maintenance issues, emergency funds for unanticipated maintenance issues, and rainy day funds. So you can think of reserve funds are your saving accounts that may be general or earmarked for specific purposes. When we look at the revenues, costs, and savings all together, we can see this put together in a water finance system diagram. So we start with the revenues on the left, where the system income can pay for all of our different costs, as well as have money set aside into the reserve funds. Next, we have debt that goes generally towards the capital projects. Note that it's not paying for operating costs. And then there are reserve funds that can pay for your capital projects, your debt service, and if needed, for your operating costs. Now, if we zoom in to consider the capital projects and improvements, there are 4 different general approaches to pay for capital improvements. So there's the pay-as-you-go option, where you need to consider having rates that need to be high enough for any emergencies in addition to the capital expenses that you want to pay for. It's also possible to save in advance, and that's related to the reserve funds that we talked about. Here, it can be important to develop a capital improvement plan or CIP. For example, if you know you need $210,000 in 15 years to pay for a specific asset, you could save $14,000 every year for the next 5 years and put that into a reserve fund. When it comes to reserve funds, there's no set answer of how much can be in a reserve fund, though some states have statutory limitations. You want to think about the overall risk within your system. For example, if you're a small residential municipality or utility with a stable population and revenue, maybe a few billing cycles of cash may be sufficient unless there's a big issue. But if you have more risk in the system or you have longer billing cycles, you may want to save more. However, you don't want to save so much that you have years of a reserve fund built up. Most of the time, reserve funds are unrestricted, but it's also possible that you can save for capital improvements, depending on your risk levels. It's also important to think about the equity issues of who pays and who benefits over time when you're considering different ways to pay for capital expenditures. For example, if you are paying for or saving up for capital that will be used in the future, your current customers aren't actually able to benefit from the money that they are contributing towards that capital. And this is an argument for borrowing and paying later through loans or bonds, because you have more time equity in that the constituents who are paying for the capital are actually able to also benefit from the infrastructure. So know that borrowing and paying later, this idea of taking out debt for loans and bonds is a norm, that eventually everyone will likely borrow through bonds or loans because capital is so expensive. This is a great time for considering subsidized loans due to the recent bipartisan infrastructure legislation. And there may never be a better time to obtain a grant for replacing your critical assets or to construct new ones. Loan opportunities are also widely available for the next couple of years. So in general, you want to be prepared of taking advantage of rates when they are as low as they can be. If you're expecting the rates to go up, and you'll know you need to replace an asset in the next 5 years, you may want to push up pursuing financing at the beginning of the 5 years instead of at the end to lock in a lower rate. So this is why asset management and capital improvement plans are tied to the financial health and planning of your system. Some examples of the subsidized loans I mentioned are from the state revolving funds, or SRF, USDA, BRIC loans from FEMA. Here, keep in mind that don't discount any funding. For example, we've known of systems who are able to find FEMA funding to repair a tank, or perhaps the area was hit with a tornado in a past year, and that could go towards paying for some capital. Just because it feels like it doesn't fit into a specific budget, do a little research. Pick up the phone and call if you're not sure, so you can turn over every rock for opportunities for funding. Another thing to keep in mind is that you don't want a loan term longer than the life of an asset. So for example, if you have a 25-year life expectancy for an asset, don't take out a 40-year loan to pay for that. And finally, look at debt service coverage before and after revenue increases. Our fourth approach to paying for capital improvements is through grants. Before COVID, we said don't count on grants. Now it's a little bit of a harder sell, but overall, it's wise to assume that you need to pay back what you borrow. And if you get a grant or a partial grant, you can decide what you want to do at that point. But it's very risky to plan on being able to get a grant, so don't do that. However, as we look at this suite of funding options, there's no guarantee that the abundance of the grant and loan funding will be as available in the future as they are right now through the SRF program. Long-term investment for financial resiliency will likely involve all four approaches for paying for capital improvements for your utility. So no matter what your approach is, planning and saving are important components for financial resiliency over the long haul. So why is understanding your revenue requirements so important? Without it, you may become financially sustainable. And when you're thinking about rates and collections, it's possible to collect too much or too little from your constituents. And it can also send the wrong message to your customers. Creating a budget is an important part of how you're going to set aside or meet the revenue requirement. And you want it to reflect the goals of the governing body. And a budget can be used to accomplish a number of goals in addition to the appropriation of funds. So during the budgeting process, also keep in mind how to reflect and promote financial and operational performance, and think about it as an opportunity to set rates and fees and for public education. We'll dive deeper into measuring financial and operational performance, as well as setting rates and fees a little bit later in this presentation. But for now, we want to set the stage so that you keep those items in mind. And finally, budgets can be used as a communication tool. When you think about it that way, keep your audience in mind. For example, within a utility, who is responsible? For leadership, what are their priorities? And with customers, how can you think of a budget to build transparency and communicate within your system? Overall, we want to budget for the full cost, and there are a number of different components, some that we've reviewed, as well as thinking about emergencies and other costs like taxes and accounting, contracts, and indirect costs, as well as retirement. And these overall will guide your other decisions. So this is important because knowing all of the costs informs how much is needed for your revenues. In our second part of the presentation, we're going to look at assessing financial condition. So I'll give you a brief overview of financial statements. Usually a financial statement, like a comprehensive audit, is used to examine the financial health of your utility. The audited financial statements are produced at the end of each fiscal year and reflect only that fiscal year. So they're ex post, unlike a budget, based on what actually happened. They're usually performed by a third party, and we're particularly interested in enterprise funds or proprietary funds. Financial statements have varying degrees of complexity, like budgets. And if you don't have a financial statement, you may be able to get this information from balance sheets, shareholder reports, or annual reports. So what are we looking for when we're looking at our financial statements? Well, we're going to extract this information and use that to compute financial benchmarks. Why do we care about these things? Well, they provide a holistic picture of utility performance and needs and allow us to set future goals and understand growth. They also inform capital planning and give us a picture of affordability as well as financial options. There are a number of different financial performance metrics, and these answer different questions around self-sufficiency, around debt coverage, around how long you could pay, and about meeting your short-term and obligations as well as assets. So today we're going to cover the top 3: operating ratio, debt service coverage ratio, and days cash on hand. But you can find out more information about quick ratios and asset depreciations and some of the other work that we do or from our websites. So first, the operating ratio. This is a measure of self-sufficiency of your utility. And you use that by taking in information about your operating revenues from your daily operations and dividing that by your expenditures or expenses that you use to keep the operations running. So, when you look at this ratio, you'll know that you want your operating revenues to at least exceed the operating expenses of a given year. So you want a ratio of at least 1.0. You can calculate the operating ratio in different ways, with and without depreciation. First, with depreciation is just dividing the total operating revenues by total operating expenses with depreciation. This gives you an indication of whether or not in a given fiscal year you had enough revenue to pay for your operations and maintenance and to put aside enough money to pay for assets that are depreciating in value and physical condition. The second metric, operating ratio without depreciation, is where you exclude depreciation from the denominator. And this changes the definition. If you exclude depreciation, then you're only asking whether or not the revenues coming in were sufficient to pay for your operations and maintenance. So I just want you to keep in mind that these are two important and very different metrics. So let's take a closer look at what's in the numerator and the denominator of the operating ratio. Operating revenues include income from rates, late fees, penalties, and other fees for connections and taps. Operating expenses, on the other side, include costs for supplies, salaries and benefits, overtime and taxes, and depreciation, but it does not include debt service or reserves. So let's dig in a little bit deeper to this funny thing called depreciation. Depreciation is an accounting solution for a physical problem that you're all familiar with of aging infrastructure. And basically assigns a cost every year of your infrastructure wearing out as a percentage of this value. And there are different ways to calculate it. But as you can see on the right in those images, this is an example of the consequences of not budgeting for depreciation or for capital investments. Infrastructure wears out over time and there's no money to be put aside in the fund to pay for replacing these assets. As you know, at some point, assets will fail, and that prevents your ability to provide the service that depend on that assets. By not budgeting for depreciation or for comprehensive capital investments, rates and fees may not have to be raised to balance the budget, but the assets won't last forever and will be very expensive to fix on short notice without reserves. So we're focusing here on the value of an asset. You can think of this in 3 different components. There's the replacement value, the current value, and historical value. And the most important of these 3 is the replacement value. This replacement value should be the cost of replacing the asset with the type of asset that the utility desires to use, which could be different from the prior asset that you had. So you may not replace like with like. For example, if you had a cast iron pipe in the past, you may want to replace it with a PVC pipe, in which case you would want to use the cost of the PVC pipe, not the cost of a cast iron pipe when you're thinking about saving for depreciation. And the other two types of costs are current value and historical value. Current value might be useful if a utility is trying to perform a valuation of all its current assets. Historical value can be interesting, but may not be as helpful in determining future costs if those costs have substantially changed. However, if you don't have information about future costs, it could be a good starting estimate to use the historical costs converted into current dollars for replacement value. So as a review, depreciation has a number of components. It includes the loss of value over time of an asset that's not restored by current maintenance. It's also an economic fact for any water or wastewater system. And it reflects the value lost from both declining physical and non-physical factors. So coming back to this idea of depreciation and operating ratio. If your utility is budgeting for future expenses and you have a capital improvement plan and you know very well what your comprehensive needs are going forward, then you should be budgeting for the O&M and all the capital investments you're expecting to be paid for. You can budget for your CIP and O&M and you should be all set. If you don't have a capital improvement plan or asset management plan, then you should at least be trying to budget for depreciation. And this is why we recommend using the operating ratio with the inclusion of depreciation. So you can fully fund depreciation and give yourself savings to replace an asset at the time that it needs. Our second metric is I do want to go back, excuse me. We'd mentioned before that you want an operating ratio of at least 1. I'd argue that it's important to have a higher operating ratio, potentially 1.1 or 1.2, so that you are accounting for sufficient cost, sufficient increase of costs into the future. All right, our second financial indicator is debt service coverage ratio. And this is a measure of the ability to pay debt service. And it's important because it's often calculated or looked at by funders and debtors. So you want to be able to make sure that you're able to generate enough revenue in a year to pay not only for O&M, but also your principal and interest payments for the total. So you can calculate this by taking your operating revenues minus your operating expenditures without depreciation and dividing this by your principal and interest payments on long-term debt. And a good benchmark for this is having a debt service coverage ratio of over 1.2. A third financial benchmark is days cash on hand. This gives you an indication of how long you could continue to pay for O&M if you didn't have any additional revenue. So imagine that your customer stopped paying today. How long could you keep providing services? This is calculated using unrestricted cash and cash equivalents that are monies that can be used for everything or for anything. So what is restricted cash? Some of the cash in the bank for enterprise funds might be restricted through bond covenants to pay for principal and interest payments or to reserve a security for your debt. You might even have a capital reserve fund that puts some of the funds aside and reserves them just for capital projects. You're not able to dip into these for restricted funds to pay for O&M, and you can only use them for specific purposes, which is why we want to focus on the unrestricted cash. So that will be what you're looking for on your financial statements, and this is the money, again, that can be used for anything. We can take the unrestricted cash and cash equivalents multiply that by 365 days in the year, and divide that by the difference between, or by operating expenses without depreciation. An example benchmark of this is having 180 days of cash on hand, but it really depends on your system and the risk in your system. Okay, so now that we've looked at these different financial benchmarks, what's next? How do we know where we're going? And how do we estimate future costs and revenues? We do have tools available through the UNC EFC as well as the Environmental Finance Network. And you can look at your past financial audits and project out into the future health of your system to look forward. So if you go onto our website, if you can, and have 5 years of financial audits, you can put that into our tool. This includes information around revenues and expenses, principal and interest, assets, etc. And it will generate for you the financial benchmarks we've covered and didn't have time to cover today. All right, the last part of our webinar is the rate setting component. And before I talked about the revenue requirement as the science, and this is the art part. So when we are setting rates, it's important that they are simple to understand and implement and change when necessary. Complex tier structures can be challenging, so try to keep them straightforward so that utility staff and ratepayers, as well as decision makers, all understand the process for setting and implementing rates. Rates should be based on expenses to cover full costs of operations and should be fair and equitable for all ratepayers. It's important that rates are not frozen in time. Rates have to increase as costs increase in order to cover the cost of operating a utility. They should not be based on political desires, but rather on what is needed for the utility and the community. It's okay to consider what other similar utilities and their rates are, but it's important to understand that each utility is unique in its community and its needs. So use your own community's information to make wise decisions about rates and setting them. There are a number of different objectives or rate design considerations that we can take into account for a water or wastewater system. These include full cost recovery, encouraging conservation, business-friendly practices, and affordability. I'll touch base on each of these in a little bit more detail. So the first is full cost recovery, or the desire for revenue sustainability, where we want to bring in enough revenue to cover the full cost of running the water system for O&M, capital needs, and debt services, those 3 costs we talked about. Now, why? Well, the goal of full cost pricing is to have the charges for water and wastewater cover the entire cost of running the system today and into the future. Now, the second objective is conservation, where you can use prices to encourage customers to reduce their water consumption. Why might this be important, and what challenges does it create? Well, you might want to encourage conservation due to a lack of source water, changes in your population. You might be nearing the storage or treatment capacity of your system, or perhaps there is drought in your area, or you want to just reap other environmental benefits. One of the challenges here is that when you decrease the amount of water produced by your system and the amount of demand from your customers, you're also restricting your revenue. So you have to account for these trade-offs between consumption and revenue. A third objective is how to encourage business-friendly practices. These, in order to locate in your community or stay within your community. Now, why you might want to do this? It might be out of a desire to increase water sales or wastewater revenue, or increase the local tax base, as well as to create jobs. And lastly, affordability. This is ensuring that your customers in your water system are able to afford enough water to live on. Now, why might you want to do this? Well, there is no nationally accepted standard for affordability of water and wastewater service. So it's important to assess affordability locally because you know your community the best and you should be able to set the threshold for affordability. Again, we're going back to this concept of full cost pricing, where we want to cover the entire cost of running the system today and into the future. There's many ways to calculate and get to the right dollar figure, but it also includes rate setting, and we'll get into the rate setting philosophy next. There are different perspectives on rate setting. Some of these include the idea that the payment for access, you can account for the payment for access as well as the payment for volumes of the product received or consumption. There's also this idea that fixed charges should pay for fixed costs and variable charges for variable costs. Or you can combine these rate setting philosophies with some mix them together. So we're going to go next into an example of rate design, focusing on the mix between these two ideas. So for this, here we have a fixed revenue provided by a base charge or base rate, since that does not change as more gallons of water are produced. Base charges may include charges for access, system development, or other fixed costs. Variable revenue comes from commodity or volumetric charges that increase as more water is produced or consumed. So it's helpful to think of these separately, and I think many of you are very familiar with these ideas. Going back to that idea that the base charge is for fixed costs and the volumetric charge for variable costs. This is in its pure form where you're trying to match fixed costs with the base charges and variable costs with the volumetric charge rates. In reality, this may be a little more challenging. When you have, this is an example for a public enterprise where the blue are the variable charges, or the variable, revenues and its expenses, and the gray are the fixed costs. So if there is a drought, and Charlotte, for example, has to provide 20% less water, revenues go down, but costs will not go down proportionally. So we can see overall in many states that we're selling less water, but bills aren't decreasing proportionally. It's therefore important that you consider raising rates to compensate and to increase your bills and revenues as a consequence. One of the key lessons that all utility managers should remember is that water and wastewater utilities are very capital intensive. The vast majority of the expenses for a utility are tied to capital and administrative costs and not to how much water is treated or distributed. Variable costs increase in the short run as more water is treated and distributed, such as the cost for energy and chemicals. Fixed costs, by contrast, are the other costs that a utility incurs that don't vary in the short run based on the volume of water produced. For most utilities, such as the example in Charlotte-Mecklenburg utility that we just showed, the vast majority of the costs are fixed, while the majority of revenues come from usage rates. So if customers reduce their consumption significantly during, for example, mandatory watering restriction periods, revenues will reduce significantly while the overall cost will not change. This is why utilities frequently have insufficient revenues during mandatory restriction periods and require a significant rate in the next year. There are ways the utility can design its rate structures to buffer this against this effect, mainly through charging higher non-variable base charges. But these methods require a balance between setting revenue stability-oriented rate structures and conservation-oriented rate structures that reward customers financially for reducing consumption. So let's go back to this idea about how would we actually calculate these base charges and volumetric charges to meet our costs. For this, you'll need to know your total revenue for your fixed and variable costs, as well as the number of accounts you have and the total gallons sold. In our example, we have about $350,000 we're generating. About $292,000 goes to fixed costs and $52,000 to variable costs. So we're going to walk through this different example. First, by calculating a monthly base bill. So if we have about $292,000 of fixed annual costs, we divide that by the total number of accounts and get an annual bill of about $650. Oops, excuse me. And we can divide that by 12 months to get a monthly base bill of $54. For our volumetric charge, we can take, again, our variable annual costs, divide that by the total number of gallons sold, which is about 33 million gallons, multiply that by 1,000, and we get about $1.59 per 1,000 gallons that we would charge as a volumetric charge. So as a review, this is where we're trying to balance our base or match our base charges with our fixed costs and volumetric charges with our variable costs in a way that's conservation oriented. You can also edit these consider rate setting that allows for a lifeline rate for small users. And this gives the opportunity for customers who manage their use an opportunity to control their costs through controlling their consumption. However, this is not the only option. In addition to rate structure designs with base and volumetric charges, as we reviewed, there are many other options, including block rate structures like increasing, decreasing, targeted block rate structures, or uniform at one block rate, or budget-based. Increasing block structures alone are not sufficient to encourage conservation. And how you design a block rate structure is critical in order to set the appropriate price signals to customers and not unduly overburden certain segments of the service population, as well as to provide sufficient revenue stability for the utility. So we want to consider a couple questions and use data-driven analysis to make decisions when possible when considering a block rate structure. So decide on the correct number of blocks and where they should start and end. For a utility to target residential consumption with increasing block rates, it should use at least 2 blocks within the normal range of residential use, usually from about 0 to 15,000 gallons per month. The increasing block rate structure for residential use should at least start the second block just over the average residential usage level. So why might you want to do this? Well, it's not good to start a second block at usage that only a very small number of customers use. In order to think about this and determine the number and size of blocks, it's very useful to analyze billing records and the number of bills sent out each month for different usage levels. Some other things to keep in mind. Remember your larger users. If the utility only uses one rate structure for all of its customers, the block sizes at much higher levels of use should be carefully considered from the perspective of commercial and industrial customers. You want to also keep in mind your base charges and consumption allowances, because you can change your consumption allowance and that can make a big difference in revenue as well as from your customer's perspective. You also want to set rate differentials that are significant between blocks. And finally, it's important how you do the meter reading is important. And that meter reading is punctual and accurate, since delays in meter reading may lead to customer jumps between blocks between billing periods. Other things that you can consider are special rates or riders. So these include irrigation rates, where you charge separately for outdoor water use and price that higher than for regular water use. This can help encourage consumption as well, or encourage conservation. Some utilities also offer seasonal rates where prices are higher during high-term uses of the year. Many times this is the summer, unless you're in a winter holiday area or get a lot of snowbirds. And finally, there are also drought riders, where you might have a surcharge when supplies are most stressful, such as during a period of forest conservation. And this is a way to compensate for reduced revenues when you have reduced consumption. Finally, you can also consider customer classes. And utilities have several options in deciding how to charge different sets of customers. However, it's important to know that depending on the state, utilities can only legally charge different rates for customers based on cost-related factors such as usage. So it's possible to set a rate structure for residential customers and a separate structure for commercial and industrial customers, since non-residential customers often use a lot more water, and the marginal cost of providing them with the additional units of water is very low. And again, depending on the state, utilities cannot charge lower or higher rates to customers based on non-cost related factors. So providing discounted rates to senior citizens or low-income customers purely based on those indicators is illegal. However, if you're interested in setting up a customer assistance program, we encourage you to check with your state about constraints of how to do that in case there are provisions in your state that are more flexible. One advantage of creating different rate classes by customers, as shown here, is that it provides utility with greater flexibility in targeting different objectives for different types of customers. For example, a utility could charge an increasing block rate structure for residential customers to encourage conservation, and then separately have a uniform rate for non-residential customers to avoid overburdening them with excessively high rates. But overall, before adding a new rate structure class, utility managers should first assess the ability of their billing software to handle the complexity of the switch, as well as the staff's ability to make the conversion and continuously monitor it, assess, and correct inevitable increase in billing errors. So a couple more notes. When you think about revenue, what might change your revenue over time? There are a number of factors that can relate to variable revenue. For example, one big thing to keep in mind is that when it comes to rate changes, as rates go up, usage goes down. As a rule of thumb, typically usage decreases by 3 to 4% for every 10% increase in rates. We call this price elasticity. You might also have changes due to population, where there are customers coming into your system or leaving your system, changing the overall demand. If you have lost a big customer, that can also have a disproportionate impact on your budget, since some customers use significantly more water than others. Another change that's happening and has been happening is that fixtures use less water today than the past. And so overall per capita water demand is decreasing across the country due to new technology. Economic downturns can also cause customers to cut back on water use, and many of you may have seen this during COVID. And then there are the effects of weather. Rainy conditions or drought or dry conditions can impact how much water customers use for outside irrigation, while also rainy conditions can affect how much additional water is entering your wastewater system. As we mentioned before, water use restrictions, whether from water supply shortages or drought, will change your revenue since there is decreased consumption. And finally, you can have changes in your rate collection, because even if the number of customers doesn't change, how often they are paying you can have an effect. So let's take a look at this example, and we want to think about budgeting as as you know, it's trying to look into the future and predict it. There are people who do projections. This is an example from Orange Water and Sewer Authority in Chapel Hill, where I'm based. And you would think that based on these trends, it would be pretty easy to do a projection that it's because actual water sales follow the accounts. However, in reality, use went down. We found that, or OWASA found that conservation pricing changed habits so that people were using less water or water more efficiently, and there were a few big events and projects that also decreased demand. This include the university reclaiming its water. So for some towns, it's a loss of industry or doubt. So here, our point is that when you're considering predictions and budgets, it's important to keep a finger on the pulse of the community and be ready for challenging scenarios. Here, I want to, in our last couple of slides, walk you through this idea of billing correctly. So this shows that overall, the point here is that the water you are treating and distributing may be very different from the water you're selling. So you can see that you have water from your own sources and imported water that goes into treatment and storage. That water goes into your system, or you might have some exports. And then here you have differences between authorized consumption and water losses. Ultimately, the authorized consumption, a portion of that ends up in revenue water, and there are different types of water losses, including unbilled authorized consumption, apparent losses, and real losses. The yellow box that we're highlighting here shows apparent losses, which highlights the low-hanging fruit for you to think about, since apparent losses don't require you to fix a pipe or anything like that. So you might want to consider trying to decrease your non-revenue water, if that's high, by decreasing unauthorized consumption, improving customer metering errors, as well as any systematic errors from data handling. Wastewater is a little bit simpler, but the thing here is that billed water often turns into billed wastewater, but you lose some to irrigation, and you gain some, so that's your non-revenue water, and then you gain some through inflow and infiltration. That includes your stormwater events, high groundwater tables, or old or broken infrastructure. So when you're thinking about wastewater, consider a couple things. One, are all of your water customers being billed for wastewater and vice versa? So some customers may tap into one or not the other. So you want to just make sure you're capturing all of your users if you're billing the same amount for water and wastewater. Another thing you can consider is whether there are any industrial users that have pre-treatment requirements because their waste is more costly to treat. For this case, you could include a surcharge if industrial customers are producing waste above a certain standard. Couple things, just as we back out, think about potential pitfalls and what not to do in rate making. Again, it's important to not make your design too complex, to understand your revenue requirement, and to consider risk. Also, we recommend not counting on growth that may not come, and this idea of build it and they will come, or forgetting to account for declining population or loss of customers. Overall, you want to save up, or it's not a good idea to save up your rate increases for one big increase and instead use incremental increases. Another problem can be if you lack communication before, during, and after the rate making process. If you're able to control the narrative, then you can control how that's perceived by your customers and your board. If you don't tell your story, somebody else will. So what do you want to do? Make multiple forecasts based on different assumptions. Be conservative overall. Don't forget this component about price elasticity, which is that idea where if you increase prices around by about 10%, you'll get a decrease in 3 to 4% for consumption. Use tools to stress test different projections. and give decision makers more options to consider. Finally, I want to remind you to make these incremental rate increases over time and communicate. In addition to the financial health checkup that I showed you before, we do have a water and wastewater analysis model and are available for technical assistance for that. And you can look at our website or the EFC network website for the tools. In addition to that, there are funding. There's more information about funding from the Southwest EFC SRF switchboard, as well as the EFC network funding tables. We are looking for particularly small water and wastewater systems who might be in need of technical assistance. And if that's the case for you, please contact UNC Environmental Finance Center or the EFC network that Kristen also talked about. Please let me know if you have any questions, and I'm happy to stop for questions now.
Wonderful, thank you, Kristen. Like Kristen said, I'm gonna open up the next couple of minutes for anyone that might have any questions. Go ahead and get those into the question box in your GoToWebinar panel. No questions yet, but someone did say that they have received help from UNC and that you guys have been wonderful.
Oh, thank you so much. Really appreciate hearing that. And again, we are here to help, so please reach out.
All right, and then we do have a question. Someone says, why might it not be best to set aside the amount of depreciation annually in a capital reserve fund?
Is the question, well, I think it is generally, if I'm understanding correctly, it is a good idea to set money aside in a capital reserve fund. I think a question would be whether it makes sense for your system to earmark that money specifically for capital reserves, or whether you might want increased flexibility for unrestricted funds. Does that answer your question?
I think that answers the question, but I'll give Shelley a minute to see. Yes,
Okay.
she said yes, thank you. And yeah, I'll leave the box open for just another minute to see if anyone else might have any last minute questions.
And Shelley, just to tag on to that, I think that's where you can think about different types of reserve funds, whether it's for, I mean, really it's how you earmark the money, but for capital reserve or rainy day funds or emergency funds, you know, and there are a couple of other different types, but I think where it, if I understand correctly, where it makes a difference is how they're earmarked for spending later. Well, I want to thank you all for spending your hour with me today, and I hope this has been a useful presentation. Please do follow up if you have any additional questions, and I'm happy to stay on for a few more minutes in case anybody has any questions now.
I just received another question.
Great.
Someone says, we are doing a system upgrade which will be completed in August. The owner is resistant to a water rate increase, and I am wondering, should we consider incremental increases?
I would say yes. I think also there's an opportunity for you to look at your finances. We do offer some additional tools called including as I mentioned, the rates tool, a financial health checkup tool, and we also have a plan to pay tool where you can consider planning out how you're going to pay for the system upgrades that it sounds like you're finishing. So if you have taken on additional debt for that, you can look at different scenarios about how to pay for that, and perhaps, you know, looking at those numbers over time, and if there are any shortfalls, that can give you an idea of what you need to cover, and with that, go back to how you can make up for that in rate increases. But in general, it is a great idea to change rates incrementally instead of in a one big change, because that's both helpful for you, or for how you communicate and your transparency and relationship with your customers. So I think having, you know, some dialogue with your board or the owner, as well as your customers, would be useful. But I think you're on the right track. Do you have any follow-up questions to that?
Nope, I am getting a lot of great webinars. Thank you so much. So yes, thank you, Dr. Downs, for sharing your expertise with us today. Following this webinar, each of you will receive a follow-up email with the slides from today and a link to the recording. We ask that you complete the webinar evaluation following this webinar, so that way you can let us know your thoughts on today's session. This helps us plan future webinars on topics that are important to you. Thank you again, everyone. We hope to see you at future EFCN events.
Thank you so much. Have a great day, all.